Hey everyone, welcome back to the channel. Today we're talking about a major move by the US Federal Reserve. They've just cut interest rates for the first time in over 4 years. What does this mean for the economy, for us as consumers, and how could it affect the upcoming US presidential election? Let's dive in, so stick around. The US Federal Reserve is responding to slowing inflation by cutting its key interest rate for the first time in more than 4 years. On Wednesday, the Fed reduced the rate by 0.5 percentage points to a range of 4.75% to 5.0%. This is the rate at which commercial banks can borrow central bank funds. It's an unusually large rate cut, and the central bank also signaled further cuts later this year. While the shift toward a more accommodative monetary policy was expected, it was uncertain whether the Fed, governing the world's largest economy, would opt for such a large rate reduction or take a more cautious approach with a 0.25 percentage point cut. Rate cut initiated. Monetary policy typically has a delayed impact, so Fed officials are likely to keep a close eye on inflation. For the Fed, balancing the fight against high consumer prices is a delicate act. If rates are too high, there is a risk of a recession. If rates are cut too soon, inflation could rise again. In the summer of 2022, inflation was over 9%. A rate cut makes borrowing cheaper, allowing companies to invest more easily and many citizens to spend less on debt payments, freeing up more income. This could stimulate the economy. However, higher returns for savers could diminish. For U.S. investors, rate cuts are positive news. The dollar is expected to weaken further, which may please travelers from Germany visiting the U.S. Monetary policy plays a role in the election campaign. The Fed's decision comes just weeks before the presidential election on November 5th. The rapid rise in prices, driven by the surge in energy costs following Russia's invasion of Ukraine and the aftermath of the COVID-19 pandemic, has weighed on U.S. President Joe Biden's administration. Many everyday goods are more expensive than they were during Donald Trump's presidency. Trump, a vocal critic of Fed Chairman Jerome Powell, has tried to politicize the Fed's interest rate decisions. He argued that the Fed should not cut rates before the November election, claiming that doing so would benefit the current Democratic administration of President Biden. Trump is running in the election against Vice President Kamala Harris. New economic data. Recently, pressure has been mounting on Powell to adjust rates, in part due to the cooling labor market. Critics of a more accommodative monetary policy argue, however, that rate cuts are currently unnecessary given the relative strength of the U.S. economy. The Fed has also released its new economic forecast for the U.S. The gross domestic product, GDP, of the world's largest economy is expected to grow by 2% in 2024, down from 2.1% in June. For 2025, the Fed forecasts the same growth rate of 2%, unchanged from its June projection. The last time the Fed cut its key interest rate was in March 2020, in response to the economic impact of the emerging COVID-19 pandemic. Afterward, rates remained near zero until the Fed began raising them at record speed in March 2022, pushing the rate to its current level over the past year. Recently, inflationary pressure in the U.S. has eased, giving the Federal Reserve more room to lower rates. The European Central Bank had already initiated its own rate shift in June. The Fed's new economic outlook suggests that further rate cuts could be expected this year. Fed officials now expect an average interest rate of 4.4% for this year, down from 5.1% in June. For next year, the Fed anticipates an average rate of 3.4% compared to 4.1% in June. Fight against high consumer prices. The Fed has also updated its inflation forecasts. For this year, it now projects a lower inflation rate than previously forecast in June, expecting an average of 2.3%, down from 2.6%. For 2025, inflation is expected to average 2.1%, the same as in the June forecast. In the medium term, the Fed aims for an inflation rate of 2%. Core inflation, which excludes food and energy prices, is expected to be 2.6% this year, down from 2.8% in June, and 2.2% next year, June 2.3%. Fed officials place special emphasis on this measure in their analysis, as it is considered a better indicator of overall price trends by excluding more volatile components.